Welcome to the very first episode of the LPEA Fund Financing podcast series where we explore the evolving landscape of fund financing in Luxembourg. I am Ana Bramao, a partner at Elvinger Hoss Prussen, and I am delighted to be joined today by Margaux Felix, a counsel at Clifford Luxembourg, and Aurélien Favier, the head of Fund Legal PE, Real Estate at Pictet. Before we dive in, let me briefly introduce the LPEA PE Financing Committee. Our mission is to showcase the advantages Luxembourg law offers for private equity financing, raise awareness among industry players, and advocate for legal developments that strengthen Luxembourg's position as a leading financial center. We are very excited to kick off this series of podcasts by setting the scene on fund financings in Luxembourg and exploring its unique characteristics and the expertise developed in this jurisdiction. Before I start asking questions to Margaux and Aurélien on the topic at hand, it is perhaps worth setting the landscape. So, Luxembourg has established itself as a leading European and international financial center. It ranks as the second fund center globally, with a significant volume of assets under management, particularly in the private equity and alternative investment sectors. As of July 2025, there were 7,603 billion euros of assets under management of Luxembourg domiciled funds, including both UCIs and AIFs. Since 2013, the introduction of the special limited partnership regime alongside the AFMD framework has greatly contributed to the success of Luxembourg's fund industry. Luxembourg is also recognized as a lender-friendly jurisdiction, owing to its robust legal framework, including the 2005 Law on Financial Collateral Arrangements and the 2020 Law on Professional Payment Guarantees. As a true hub for both investment funds and financings, Luxembourg has fostered significant expertise among market practitioners, including service providers and lenders. The ecosystem includes experienced legal advisors, banks, and fund administrators who are familiar with the specific requirements of fund finance transactions. Aurélien, could you walk us through how a fund is typically structured and how this affects financing arrangements?
Sure, thank you, Anna. Contrary to financing, which involve a single and regulated SPV, fund structure are more intricate. And actors include, depending on the type of fund and financing, the fund itself, the management body of the fund, so it can be the board or the GP, for instance, its management company, referred to as the Margaux or the IFM, its portfolio manager, the depository bank, the administrative agent, the domiciliation agent, the auditors, the account bank, and the lender. So this structure can really introduce additional complexity in the financing transaction, and it requires careful consideration of security arrangement, cash flow, intercreditor issue, but they also provide for greater flexibility and efficiency.
Thank you very much, Aurélien. Margaux, can you tell us what are the typical financing structures and security packages involving Luxembourg funds?
Of course. So I won't go into details on the security package, as I think this will be covered on another episode, but here is a brief overview. So I think the main distinction is between a subscription line financing and net asset value financing. And these two financing really constitute the most common types of financing we see. On one end, subscription line facilities are loans which are granted to alternative investment funds and which are secured against the undrawn investor commitments. So this type of financing really allows the fund to, at their early stage, to have an immediate access to cash, to enable a very swift investment execution, but also to smoother the capital call timing. In such case, the security will be taken over the claims the fund has against its investors, under, of course, the commitment, and the bank account on which such contributions are paid. On the other end, a net asset value, so NAV facility, is a type of financing where the loans are actually secured against the net asset value of the fund's portfolio rather than the investor's commitment. So it would be typically used in the later stages of a fund's life and with the aim to support portfolio companies, bridge capital gaps, and even facilitate interim distributions without triggering an asset sale. So in such case, of course, the security package will be completely tailored to the asset class being financed. So how this will work is that the lenders will look into the investment portfolio and they will determine which security to take over the assets. We see different type of security, of course, amongst other, first, security over the bank accounts on which the proceeds from the investments are received. We also see security over intragroup claims, and notably distribution claims, which are owned by the portfolio entities. And lastly, we also sometimes see security over the shares or the interests of portfolio company or intermediary vehicles. So, obviously, this is a very general overview, and there are other financing structures, actually as many as there are different fund structures. So this will have an impact on the complexity of the financing, and this needs to be assessed by the banks and the legal advisors.
Thank you very much. Aurélien, when we turn to the difference between regulated and unregulated funds, does the setup above apply to all funds? Do both regulated and unregulated funds borrow, guarantee, and secure their assets in the context of financing?
So excluding UCITS, which face very different limitations, all other type of alternative funds can be involved in financing, be it regulated or unregulated funds. Here, really, the crucial point is more to ensure that the constitutive documents are properly drafted to enable the fund to enter the right type of financing for its investment strategy. And a particular attention must be paid to the borrowing, the guaranteeing, the securing limitation section in those documents. And also a point to mention is the disclosure to investor for more transparency.
Thank you very much, Aurélien. Margaux, would you please care to say a few words to conclude on this episode?
Sure. So, as a word of conclusion, I think we can say that Luxembourg has really solidified its reputation as a premier destination for fund finance transactions, thanks to three main factors. First, a very robust legal framework. Second, a lender-friendly environment. And third, a deep pool of specialized expertise. So the jurisdiction really continues to attract global investors and fund sponsors, ensuring its ongoing prominence in the European and international financial landscape.
That wraps up our first episode of the LPEA Fund Financing podcast series. In future episodes, we'll dive deeper into the legal and commercial issues facing market participants. Thank you very much, Aurélien and Margaux, for your valuable insights, and thank you to our listeners for joining us. Until next time.